Welcome to The Explainer. Today, we're diving into one of the absolute most terrifying economic events in modern history, the 2008 financial crisis. Former Fed Chairman Ben Bernanke actually said this could have easily triggered a 1930-style global meltdown. We're talking catastrophic implications here.
But hey, put down your crossbows. We survived. Despite how dangerously close we came to the edge, we aren't huddled around burning trash cans forming raiding parties for gas in the wasteland. Things actually got better. But how exactly did we get so incredibly close to the brink?
Let's look at our roadmap for today. We'll quickly cover the basics of mortgages, the building of the housing bubble, what actually happened when it burst, the government's response, and finally, the hard lessons learned about moral hazard.
All right, part 1, the basics of mortgages. Let's see how it all started.
So here's the thing. Your local bank doesn't actually just hold your mortgage paper for 30 years. Back in the 2000s, global investors were desperately hunting for low-risk, high-return investments instead of those low-paying U.S. Treasury bonds. Because of this huge appetite, banks were constantly selling mortgages right up the chain. They'd lend you the money, sure, but then they'd immediately sell your mortgage to a third party, where it was bundled up and sold as shares to those global investors.
Moving into part 2, building the housing bubble, or as I like to call it, financial alchemy.
The absolute crux of this whole thing is the mortgage-backed security, or MBS. This is where large financial institutions bought up literally thousands of individual mortgages, bundled them all together into a giant pool, and then sold shares of that pool to investors. And investors, man, they absolutely gobbled these up. Why? Because they paid a way higher rate of return, and credit rating agencies were slapping AAA ratings on them, basically guaranteeing them as the safest investments on the planet.
But this setup created a wildly dangerous cascading effect. To feed this insatiable investor demand for mortgage-backed securities, lenders urgently needed more mortgages. So what did they do? They completely gutted their loan standards. They started handing out incredibly risky subprime mortgages to folks with low incomes and poor credit. And eventually, this just evolved into straight-up predatory lending. We're talking loans handed out without even verifying the borrower's income and pushing these absurd adjustable rate mortgages where the initial payments were super low, but then completely ballooned out of nowhere.
And the madness escalated even further. Wall Street traders just kept packaging these increasingly terrible loans into brand new acronyms, like collateralized debt obligations, or CDOs. And shockingly, the credit rating agencies still gave many of these the highest possible ratings. You might be wondering, how does that make any sense? Well, because house prices just kept going up and up, everyone wrongly assumed the underlying real estate made it a foolproof bet. The logic was basically, hey, even if a borrower defaults, we just sell the super valuable house, right? Well, that brings us to part 3, when the bubble bursts, the total collapse.
So the whole thing fell apart the second those adjustable rate mortgages reset. Borrowers simply couldn't afford those massive new balloon payments. As defaults skyrocketed, it forced an insane number of houses right back onto the market. This created a classic economic whiplash. We had a massive supply of houses flooding the market, while simultaneously demand completely dried up because absolutely nobody was buying.
Suddenly, the literal bedrock of the entire financial system crumbled. Because of that massive oversupply, home prices completely collapsed. Almost overnight, borrowers found themselves owing way more on their mortgages than their homes were actually worth. Naturally, many people simply stopped paying. That led to even more defaults, which threw housing prices into a total uncontrolled freefall.
This triggered an unbelievably complicated web of collapsing assets around the globe. Big investors stopped buying, which left subprime lenders permanently stuck holding the bag on these bad loans. By 2007, major Wall Street players began going bankrupt, most famously Lehman Brothers. On top of that, unregulated insurance policies on these investments, called credit default swaps, which were heavily sold by companies like AIG, completely failed because they just didn't have the cash to pay out the claims. Nobody knew who was holding the toxic assets, credit markets entirely froze up in a blind panic, and the stock market crashed, plunging the U.S. right into a disastrous recession.
Okay, part 4, the government response. Bailouts and stimulus.
With everything melting down, the government stepped in with a staggering number. They launched the Troubled Assets Relief Program, or TARP, and ended up spending $250 billion to bail out the banks. Combined with emergency lending from the Federal Reserve, this colossal injection of cash finally helped stop the cascade of panic and unfreeze the financial system.
But that wasn't all. Adding to the sheer scale of the rescue, Congress passed a massive stimulus package in January 2009, pumping another $800 billion into the economy.
This was done through new spending and tax cuts, all just trying to desperately slow the free fall of lost spending, lost economic output, and skyrocketing unemployment.
Following this rapid-fire timeline of disaster, the major bankruptcies in 2007, the TARP bailouts in 2008, and that massive economic stimulus in 2009, the government finally realized the rules of the game just had to change. So in 2010, Congress passed the Dodd-Frank Act. This law was strictly designed to increase transparency, reduce predatory lending with the new Consumer Protection Bureau, and most importantly, put safety mechanisms in place so that if large banks failed in the future, it would happen in a controlled manner, rather than taking the whole global economy down with them.
Which leads us to our final section, Part 5, Lessons Learned, specifically regarding moral hazard and perverse incentives.
A massive driver of this entire crisis was this idea of perverse incentives. This is when a policy accidentally causes the exact opposite effect of what was intended. For example, mortgage brokers were routinely handed these fat financial bonuses just for writing more loans, regardless of whether those loans were actually good. This perfectly incentivized them to write terrible, super risky loans, putting short-term personal greed way ahead of long-term market stability.
And that feeds directly into our next big concept, moral hazard. This happens when someone takes on extreme risk, precisely because they know somebody else is going to bear the ultimate burden if it all goes south. Basically, everyone in the chain, from the local lender closing a subprime loan, all the way up to the Wall Street banker packaging it into a CDO, they all thought they could just cleanly pass the risk up the line to somebody else.
Former Fed Chairman Alan Greenspan absolutely hammered home the ultimate moral hazard when he said, if they're too big to fail, they're too big. If massive financial institutions inherently know the government will eventually bail them out just to prevent an economic collapse, well, they have a built-in, undeniable incentive to make incredibly unwise bets with our money. Think about it. If they win, they keep all the profits. But if they lose, the taxpayer foots the bill.
So when we look back and try to find someone to blame for all this pain, the really uncomfortable truth is that the blame was spread literally everywhere. The government and regulators were totally asleep at their posts, blinded by this false faith that markets would just self-correct. Financial institutions took on monumental, insane amounts of debt for highly risky assets. And yeah, everyday homeowners eagerly took on mortgages they objectively knew they could never afford. It was a massive, systemic failure of human ethics, regulation, and understanding.
I want to leave you with this final, provocative thought from the official Financial Crisis Inquiry Commission, which actually paraphrased Shakespeare to make its point. The fault lies not in the stars, but in us. This wasn't some unavoidable natural disaster. This catastrophic failure was carefully built by our own human decisions. So the ultimate question we have to ask ourselves today is this: have we truly fixed the perverse incentives in our system, or are we just waiting around for the next set of dominoes to fall? Thanks so much for joining me for this explainer. See you next time.